It never starts with panic. Not in housing, not in California. It starts quietly, almost politely, like a market trying to correct itself without drawing attention. A price cut here, a longer listing there, a home that sits just a little too long under the sun, waiting for buyers who never quite arrive. In early 2026, that quiet shift is no longer easy to ignore. Across California, the same pattern is repeating itself in city after city. Homes that once attracted bidding wars are now seeing reductions within weeks. Sellers who once dictated terms are adjusting expectations, and buyers, for the first time in years, are beginning to hesitate. Not because they've disappeared, but because the urgency is gone. The frenzy that defined the early 2020s, the rush, the fear of missing out, the relentless upward pressure on prices, that energy has faded. What's replacing it is something slower, heavier, and far more consequential. A recalibration. But in some cities, it's already becoming something else. A decline. Take a drive through parts of inland California, and the signs are subtle but unmistakable. Fresh listings with reduced price tags, open houses that feel quieter than they should, agents who speak in more measured tones, no longer promising quick sales above asking. These are not isolated signals. They are part of a broader shift that's beginning to take shape across the state. And while the headlines still debate whether it's a correction or a crash, the reality on the ground is more nuanced, and in some places more serious. Because not all markets move the same way. Some cities resist, some stabilize, and some, often the ones that rose the fastest, begin to fall first. This is where the story begins. In cities where price growth once felt unstoppable, the reversal is now underway. Places like Stockton, where affordability once drew waves of buyers escaping the Bay Area. During the boom, demand surged, pushing prices higher at a pace that felt almost detached from local incomes. But as interest rates climbed and remote work began to normalize into something more restrained, that demand started to cool. At first, it was barely noticeable. Then listings began to accumulate. Homes that would have sold in days were now taking weeks. Price reductions became more common than expected. Sellers who entered the market late, hopping to catch the peak, found themselves chasing it downward instead. And Stockton is not alone. Further south, in cities like Riverside and San Bernardino, the same dynamics are unfolding. These were markets built on migration, buyers priced out of coastal regions seeking more space, more affordability, more opportunity. For a time, it worked. Prices climbed, new construction expanded, demand seemed durable. But affordability has limits. And by 2026, those limits are being tested. Higher mortgage rates have changed the math in a fundamental way. Monthly payments, not just home prices, now define what buyers can afford. And in many of these inland cities, the numbers no longer align as easily as they once did. The result is a market that feels slower, heavier, and increasingly uncertain. Buyers are still present, but they are cautious. They negotiate, they wait, they compare options in ways they didn't just a few years ago. And sellers are adjusting to a reality that feels unfamiliar. The expectation of easy appreciation is gone. Now timing matters again. Pricing matters again. And in some cases, even that isn't enough. Because what's happening in 2026 isn't just about demand cooling, it's also about supply returning. During the peak years, many homeowners chose not to sell. Low mortgage rates locked them in, creating a kind of artificial scarcity that supported higher prices. But as time passes, life circumstances change, people relocate, financial pressures build, investors reassess. Gradually, more homes are entering the market. Not all at once, but enough to shift the balance. And in cities where demand is already weakening, that shift can have a compounding effect. More listings lead to more competition. More competition leads to price reductions, and price reductions begin to reset expectations, not just for sellers, but for the entire market. It's a feedback loop, and once it starts, it's difficult to stop quickly. In Sacramento, a city that once stood as a symbol of pandemic-era migration, the shift is becoming increasingly visible. For a time, it absorbed an influx of buyers seeking alternatives to the Bay Area's high costs. Prices responded accordingly, climbing at a pace that surprised even seasoned observers. But growth driven by migration is sensitive. When that flow slows or reverses, the impact can be immediate. By early 2026, Sacramento is seeing longer listing times and more frequent price adjustments. It's not a collapse in the dramatic sense, but it is a clear departure from the momentum that once defined the market. And for many homeowners, that shift is enough to change behavior. Some choose to wait, hoping conditions will improve. Others choose to sell now, before prices move further. That decision, wait or sell, becomes a defining feature of a transitioning market. Because every seller who decides not to wait adds to supply. And every buyer who decides to wait reduces demand. It's a quiet imbalance, but a powerful one. Meanwhile, in parts of Southern California, similar patterns are emerging, though often masked by higher price levels and more constrained inventory. Cities that experienced rapid appreciation during the boom are now facing the early stages of correction. Not dramatic drops, but steady, consistent pressure. It's the kind of movement that doesn't always make headlines, but reshapes markets over time. And beneath it all, there's a broader question forming. Not just where prices are going, but what kind of market California is becoming. Because for years, the story was simple. Limited supply, strong demand, rising prices. Now that story is changing. Supply is no longer as constrained, demand is more selective, and prices, in some cities, are beginning to reflect that shift. But this isn't happening evenly. Some areas remain relatively stable, supported by stronger job markets or tighter inventory. Others are more exposed, more sensitive to changes in affordability, migration, and investor activity. Those are the cities where the pressure builds first. And often fastest. By mid-2026, the gap between these markets is becoming more pronounced. The idea of a single California housing market feels less accurate than ever. Instead, there are multiple markets, each responding differently to the same set of economic forces. And in at least 10 of those cities, the direction is becoming clear. Prices are no longer rising. They're adjusting. Sometimes gradually, sometimes more quickly than expected, but always with the same underlying message. The market has shifted, and the era of easy gains is over. For now, the changes remain measured. There is no widespread panic, no sudden collapse across the entire state. But in the cities where declines have already begun, the trajectory is difficult to ignore. What started as a slowdown is becoming something more defined. A correction that, in certain places, is starting to look like the early stages of a downturn. And as the year unfolds, the question is no longer whether prices can fall. It's how far they might go and which cities will feel it the most. Because this story is still in motion. And the next phase is already beginning. By the middle of 2026, the shift is no longer subtle. What began as hesitation has started to take shape as behavior. Buyers are not just cautious now, they are deliberate. They move slower, they ask more questions, and most importantly, they walk away. That single change, buyers walking away, begins to alter everything. In the previous cycle, hesitation was costly. Waiting meant paying more later. But now, waiting feels safer, even strategic, because in more and more cities, the direction of prices is no longer uncertain. It's downward. Not sharply in every case, but consistently enough to reshape expectations. And once expectations change, the market follows. In places like Stockton and Sacramento, where early signs of weakness first appeared, the effects are now more visible. Inventory has grown, not explosively, but steadily. Each week adds a few more listings. Each month builds on the last. And unlike before, those listings are not disappearing quickly. Homes sit. Days on market stretch longer. What was once measured in single digits now moves into weeks, sometimes longer, and with time comes pressure. Sellers begin to adjust. At first, they resist. Many anchor themselves to past prices, to what their neighbor sold for 6 months ago or what an agent suggested at the peak. But the market no longer supports those numbers. So the first price cut appears. Then another. Sometimes small, sometimes more aggressive. And in neighborhoods where multiple sellers are competing at once, those reductions begin to stack on top of each other, creating a quiet but undeniable downward pull. It's not panic selling. Not yet. But it is something more structural. Because the pressure is not coming from one source, it's coming from several all at once. Interest rates remain elevated compared to the ultra-low levels that fueled the earlier boom. That alone has reshaped affordability in a profound way. A buyer who could comfortably afford a home in 2021 or 2022 now faces a very different calculation. Monthly payments are higher. Budgets are tighter. Margins are thinner. And in markets where prices ran ahead of incomes, that difference is now being felt most sharply. Cities like Riverside and San Bernardino, once seen as accessible alternatives, are beginning to reflect this reality. The influx of buyers that once defined these areas has slowed. Some have been priced out entirely, not by home values alone, but by the combined weight of prices and borrowing costs. Others are simply choosing not to stretch. They wait, they watch, and they negotiate. This shift in buyer behavior introduces something that had been largely absent during the boom years: leverage. For the first time in a long time, buyers have options. They can compare listings, they can request concessions, they can take their time without the fear that every property will vanish overnight. And when buyers gain leverage, sellers lose control. That imbalance becomes especially clear in markets where inventory is building faster than demand. In parts of the Central Valley, the pattern is repeating with increasing clarity. Homes that once attracted multiple offers now receive only a handful of showings. Open houses feel quieter. Agents adjust their language, focusing less on urgency and more on value. Even new construction, once a steady force in these regions, is beginning to feel the strain. Builders, facing slower sales, start offering incentives, rate buydowns, closing cost assistance, upgrades included at no extra charge. These are not signs of strength. They are signs of adaptation. Because builders, like individual sellers, respond to the same underlying pressure, the need to move inventory. And when that pressure builds, prices rarely remain untouched. Meanwhile, in Sacramento, the story is becoming more layered. It's not just about slowing demand or rising supply. It's about the interaction between the two. As more listings enter the market, buyers gain even more choice, and with choice comes selectivity. Homes that are well-priced and well-presented still sell, but even they take longer than before, and homes that miss the mark, even slightly, can linger. That distinction between homes that sell and those that don't becomes sharper in a transitioning market. It creates a kind of segmentation, a market within a market, where some properties move and others wait. And the longer they wait, the more pressure builds. Because time in real estate is rarely neutral. Every additional day on the market raises questions. Why hasn't it sold? Is it overpriced? Is there something wrong? Those questions don't just affect one listing, they ripple outward, influencing buyer perceptions across entire neighborhoods. And over time, they begin to shape pricing itself. Further south, in parts of Southern California, the shift is less dramatic, but no less important. Higher price points and tighter supply have slowed the pace of decline, but they have not stopped it entirely. Instead, the market is adjusting in a more measured way. Fewer bidding wars, more negotiations, occasional price reductions where there were once only increases. It's a different kind of slowdown, one that moves gradually, almost quietly, but still changes the trajectory of the market. And for many homeowners, that change is enough to alter decisions. Some who plan to sell later choose to list now, hoping to avoid further declines. Others decide to hold, unwilling to accept lower offers. That divergence creates uncertainty. Because when sellers are unsure, pricing becomes inconsistent. And when pricing is inconsistent, markets become harder to read. This uncertainty is one of the defining features of 2026. It's not just about falling prices, it's about unclear direction. How far will prices drop? How long will this last? Where is the bottom? No one answers these questions with confidence. Not buyers, not sellers, not even professionals who watch the market closely. And in that absence of certainty, caution becomes the default. Buyers hesitate, sellers adjust, and the market moves slowly but steadily in response. But beneath this gradual movement, there are early signs of something more concentrated. Not every city is experiencing the same level of pressure. Some are clearly more vulnerable. These are often the markets that share a few key characteristics. Rapid price growth during the boom. Strong reliance on migration. Higher sensitivity to interest rates. And in some cases, a larger presence of investors. When conditions shift, these markets tend to react first and more intensely. Because the factors that once pushed prices up can also pull them down. As migration slows, demand weakens. As investors step back, liquidity decreases. As affordability tightens, fewer buyers can step in to replace those who leave. It's a chain reaction. And in certain cities, that chain reaction is already underway. By late 2026, the gap between stronger and weaker markets is no longer subtle. It's visible. Some areas remain relatively stable, supported by local demand or constrained supply. Others are clearly moving in a different direction. Prices trending downward. Listings accumulating. Time on market expanding. These are not isolated signals anymore. They are patterns. And patterns, once established, tend to persist. The question is not whether the market has changed. That much is already clear. The question is how far this change will go and which cities will feel the deepest impact. Because while the broader narrative still speaks of a cooling market, the reality in some places is moving beyond that description. What began as a slowdown is evolving into something more defined. A correction that is gaining momentum. And in a handful of cities, that momentum is starting to accelerate. The kind of acceleration that doesn't just adjust prices, but reshapes expectations entirely. Because once enough sellers begin to lower prices and enough buyers begin to expect those reductions, the market can shift faster than anyone anticipates. Not overnight, but faster than the slow, careful pace that defined the early stages. And as that shift unfolds, the list of cities feeling the pressure most intensely becomes clearer. These are the places where the story is no longer about possibility. It's about reality. Declines are happening, and in some cases, they're beginning to deepen. By late 2026, the market is no longer searching for direction. It has found one. And in a growing number of California cities, that direction is becoming harder to ignore. Prices are not just adjusting anymore, they're slipping with consistency, not dramatically in every neighborhood, not all at once, but enough to establish a pattern. And in housing, patterns matter more than moments. Because once a pattern is recognized, behavior changes faster. Buyers who once hesitated now wait intentionally. They don't rush offers, they don't stretch budgets. They assume, quietly but confidently, that better opportunities may come. And increasingly, they're right. Listings that enter the market at last year's prices are no longer met with excitement. They are met with silence. Days pass, showings remain limited. Offers, if they come at all, arrive below asking. And then the reductions begin. At first, small enough to preserve pride, a modest adjustment, a signal of flexibility. But when that doesn't work, the next cut comes faster. And the one after that comes with less hesitation. Because by this stage, something important has shifted, not just in the numbers, but in psychology. Sellers are no longer testing the market. They are reacting to it. In cities like Stockton, Sacramento, and parts of the Inland Empire, this shift is becoming increasingly visible. Entire neighborhoods begin to reflect a new reality where price reductions are no longer exceptions, they are expected. A listing without a reduction starts to feel incomplete. And once that expectation takes hold, it feeds into itself. Buyers wait for the cut. Sellers anticipate it. And the market adjusts accordingly. But beneath this surface-level movement, a deeper layer of pressure is beginning to form. Not all sellers are the same. Some have flexibility, they can wait, they can rent out the property, they can hold through uncertainty. Others cannot. And it is this second group that begins to change the pace of the market. By late 2026, early signs of forced selling start to appear, not widespread, not yet dominant, but present enough to matter. A homeowner facing a job relocation without the luxury of timing. An investor seeing declining returns and choosing to exit. A household adjusting to rising costs, where holding onto a property becomes increasingly difficult. These are not dramatic stories on their own. But collectively, they introduce urgency into a market that had been moving slowly. And urgency changes pricing. A seller who needs to sell does not wait for the perfect offer. They accept the realistic one. Sometimes they accept less. And each time that happens, it creates a new reference point. A new comparable sale. A lower benchmark. The benchmark doesn't stay isolated. It spreads, quietly at first, then more noticeably, as appraisals, agent expectations, and buyer perceptions begin to adjust. This is how declines accelerate. Not through a single event, but through accumulation. One sale at a lower price. Then another. Then a cluster of them within the same area. And suddenly, what felt like a slow adjustment begins to feel like movement. In parts of Riverside and San Bernardino, this process is becoming clearer. These markets, once defined by rapid growth, are now showing the other side of that cycle. Homes that appreciated quickly are now more sensitive to downward pressure. The gap between what sellers want and what buyers are willing to pay becomes harder to bridge. And when that gap persists, prices move to close it. Meanwhile, inventory continues to build. Not explosively, but steadily enough to matter. Each new listing adds another option for buyers. And in a market where buyers are already cautious, more options don't create urgency, they reduce it. A buyer who sees 10 homes today may wait to see 12 tomorrow. And that waiting reinforces the cycle. Because time, once again, becomes the silent force shaping outcomes. Homes that sit too long attract attention, but not the kind sellers want. They signal weakness. And in a market where perception matters, that signal can be as powerful as any economic factor. Further north, in areas like Sacramento, the interaction between rising inventory and selective demand is producing a more fragmented market. Some homes still sell, particularly those that align closely with current conditions, but many do not. And the longer they remain unsold, the more pressure builds, not just on those listings, but on surrounding ones. Because buyers don't evaluate homes in isolation. They compare, they measure, they wait for advantage, and increasingly they find it. This shift in advantage from seller to buyer is one of the defining features of this phase. It's not absolute, it doesn't apply equally to every property or every neighborhood, but it is present and it is growing. And as it grows, it begins to influence behavior in ways that extend beyond individual transactions. Developers slow new projects. Investors become more selective or step back entirely. Homeowners reconsider selling plans. Each of these decisions feeds into the broader market, shaping supply, demand, and ultimately price. But perhaps the most significant change is not structural. It's psychological. For years, the dominant belief in California housing was simple: prices rise. There might be pauses, there might be brief corrections, but the long-term direction felt certain. That belief influenced everything, from buying decisions to investment strategies to personal expectations. By late 2026, that belief is being tested. Not shattered entirely, but challenged enough to introduce doubt. And doubt in a market built on confidence can be powerful. Because when people are no longer sure that prices will rise, they behave differently. They take fewer risks. They demand better value. They wait. This waiting, subtle at first, then more widespread, acts as a brake on the market. It slows transactions. It extends timelines. It puts pressure on sellers. And over time, it contributes to further price adjustments. In some cities, this process remains controlled. In others, it begins to accelerate. These are the places where multiple pressures converge, where affordability is strained, where migration has slowed, where inventory is rising, and where investor activity is pulling back. In these environments, the market doesn't just adjust. It moves. And once it starts moving, it can be difficult to predict how far it will go. By the final months of 2026, the distinction between a cooling market and a declining one is no longer a matter of interpretation in these cities. It is visible in the data, visible in listings, visible in conversations between buyers, sellers, and agents. The language has changed. Less about opportunity, more about timing. Less about growth, more about stability or preservation. And for some sellers, even preservation becomes uncertain. Because as comparable sales continue to reset at lower levels, holding out for past prices becomes increasingly unrealistic. The market has moved, and it is not waiting for everyone to catch up. This is the phase where momentum matters most. Because momentum, once established, tends to carry forward. Not indefinitely, not without interruption, but long enough to reshape expectations, strategies, and outcomes. And in at least 10 California cities, that momentum is now clearly pointed in one direction. Down. Not dramatically in every case. Not evenly across every neighborhood. But consistently enough to define the trend. And once a trend is defined, the final question begins to take shape. Not whether the market is declining, but where the bottom might be and what it will take to reach it. Because every cycle, no matter how gradual its beginning, eventually reaches a point of clarity. A moment when the uncertainty gives way to recognition. When participants understand not just that the market has changed, but how. That moment is approaching. And what comes next will determine how this chapter of California housing is ultimately remembered. By the time the year begins to close, the uncertainty that once defined the market has started to settle into something more concrete. Not clarity in the absolute sense, but recognition. The kind that doesn't come from headlines or forecasts, but from repetition of outcomes, of behaviors, of patterns that no longer feel temporary. Across California, the idea of a single, unified housing market has given way to something more fragmented, more uneven, and more revealing. Because by now, it's clear that not every city is experiencing the same reality. Some have slowed, some have stabilized, and some quietly but undeniably have declined. These are the cities where the shift has gone beyond hesitation, beyond adjustment, into something more sustained. Places like Stockton, where rapid growth once created momentum that felt self-sustaining, now reflect the opposite effect. Price reductions are no longer notable, they are routine. Listings move, but only when they align with the new expectations of buyers who have regained patience. In Sacramento, the story is less abrupt, but no less meaningful. What was once a destination for overflow demand has become a test case for what happens when that demand softens. Homes still sell, but the terms have changed. Time has returned to the process, and with it, negotiation. Further south, in Riverside and San Bernardino, the pressure is more pronounced. These markets, shaped heavily by affordability-driven migration, are now confronting the limits of that model. As borrowing costs remain elevated and price growth outpaces local incomes, the pool of qualified buyers has narrowed. And when that pool narrows, the effects ripple quickly. Homes sit longer, sellers adjust faster, and prices respond accordingly. These are not the only cities experiencing this shift, but they are among the clearest examples of how quickly momentum can change when the underlying drivers weaken. Because the factors that once pushed these markets upward, migration, affordability, investor interest, have either slowed or reversed. And in their absence, the market is left to find a new balance. That balance, at least for now, is lower. Not collapsing across the board. Not erasing years of gains overnight. But moving steadily enough to redefine expectations. By late 2026, the idea of waiting for the peak has largely disappeared from conversations. In its place is a different kind of thinking, more cautious, more grounded, more aware of risk. Sellers no longer assume appreciation. Buyers no longer fear missing out. And this mutual shift creates a market that feels fundamentally different from the one that existed just a few years earlier. It's slower, more deliberate, and in some ways more rational. But that rationality comes with consequences. Because when markets move from emotion to calculation, prices tend to reflect reality more closely. And reality, in many of these cities, is still adjusting. The question that now takes center stage is not whether prices have fallen, but whether they have finished falling. And the answer, for now, remains uncertain. Because while some of the pressures driving the decline are beginning to stabilize, others remain firmly in place. Interest rates, though no longer rising as sharply, are still high enough to limit affordability. Inventory, while not overwhelming, is elevated compared to the constrained levels of the past. And perhaps most importantly, psychology has shifted. Buyers believe they have time. And as long as that belief holds, urgency remains low. Without urgency, prices rarely rise quickly. And in some cases, they continue to drift downward. But every market cycle eventually reaches a point where conditions begin to align differently. where supply stabilizes, where demand finds a new footing, where expectations adjust enough to bring buyers and sellers back into closer agreement. The early signs of that process are beginning to appear, but only in certain areas and only faintly. In some neighborhoods, well-priced homes are attracting interest again. In others, bidding competition, once absent, is starting to re-emerge, though on a much smaller scale. These are not signals of a rebound. Not yet. But they are reminders that markets do not move in a straight line forever. Even in decline, there are moments of pause. Moments where the pace slows, where the direction becomes less certain, and where the next phase begins to take shape. For California, that next phase will depend on a combination of factors: economic, demographic, and psychological. If borrowing costs ease, affordability improves. If migration patterns shift again, demand could return to some of the markets that have softened. If inventory stabilizes, the downward pressure on prices may lessen. But none of these changes happen instantly. And until they do, the current trajectory remains intact in the cities that have already begun to decline. Those cities, the ones where prices are slipping, where listings are building, where expectations have reset, will likely continue to lead the trend. Not because they are fundamentally weaker in every sense, but because they are more exposed to the forces reshaping the market. They rose quickly. They adjusted quickly. And now they are navigating the consequences of both. By the end of 2026, the narrative is no longer about whether a housing correction has arrived. It's about how deep it runs and where it matters most. For some homeowners, the impact is limited: a shift in timing, a change in strategy, a decision to wait. For others, particularly those who entered the market near its peak, the impact is more immediate. Equity narrows, options become constrained, and decisions carry more weight. But even within this environment, it's important to recognize what this moment represents. Not an end, but a transition. Housing markets, like all markets, move in cycles. Periods of rapid growth are followed by periods of adjustment. Moments of certainty give way to moments of doubt. And over time, those cycles create the conditions for the next phase to emerge. What California is experiencing in 2026 is part of that process. A recalibration after years of acceleration. A return to balance after a period of imbalance. And while the term crash may capture attention, the reality on the ground is more measured, more complex, and still unfolding. In at least 10 cities, prices are clearly moving lower. The reasons are visible. The patterns are established. And the implications are still developing. But beyond those cities, the broader story is still being written. Because markets do not stop at correction. They evolve. They adapt. And eventually, they find a new direction. The only question is how long that process will take, and who will feel it most along the way. For now, the answer is still forming. Quietly, gradually, just as it began.